Good everyone, welcome back to our next edition of Econ Talks. Gareth, the day has finally arrived. We've got the better inflation data we've been looking for. The Consumers Price Index up 2.2% over the last year to September 2024. That's a good result. It's back within the target band. It's close, in fact, to the Reserve Bank's midpoint that they look for around the 2% mark. It's in line with our forecast expectation. It was ever so slightly better than the Reserve Bank and the markets. I mean, this is a good time, right?
It is. I mean, it's 3 years since we've been inside the target band, and obviously inflation a couple of years ago was peaking it up over 7% per annum. So to get it back down close to that midpoint is good news. In terms of relative to forecasts, you mentioned it was slightly better than what the Reserve Bank had been picking, and that came through on the non-tradable side in particular, where non-tradable inflation got back under 5%. So still quite high, higher than the sort of 3% per annum that we've seen throughout history over the last 30 years or so, but it is moving in the right direction, and that was better than the Reserve Bank had anticipated. So it's signs there that those domestic price pressures are coming back under control, and indeed the Reserve Bank's own forecasts of non-tradable inflation over the next year do have it getting back towards 3% within the next 12 months or so. So there's a confidence, I think, in their numbers that the domestic side of things is softening, the demand pressures coming through there weaker, and therefore prices are not rising as quickly at the moment.
Which is encouraging, as well as, of course, you had the fall in tradables inflation, a lot of that around fuel prices and similar. Again, normally, in a sense, the Reserve Bank would look through some of that, but the fact that it helped get back in the band, and importantly, the fact that those higher fuel costs, in prior years had actually been contributing through and sort of bleeding into other pricing pressures, the fact that it's come back the other side, quite encouraging. Quite a lot of still moving parts, though, below the surface. I noted when you look through the numbers, quite a lot of government charging changes emerging in the inflation figures, the likes of the Family Boost program, the government's new subsidy rebate effectively for early childhood education, pulling back effective prices for early childhood education that households are paying, and so therefore effectively a decline on inflation relative to before. The removal of the Auckland regional fuel tax, again, a bit of a pullback down on inflation. At the same time, though, the government has reintroduced the prescription charges, which has lifted inflation relative to before. So a few sort of bigger, chunkier moving parts when it comes to the government pricing. A few other probably bigger things that we're also watching as well. What sort of caught your eye in terms of some of those components of inflation?
Yeah, we're talking about the government side of things. I mean, that was all central government, but local government, of course, rates were up on average by 12% from the previous year, and Stats NZ noted that was the biggest rise since 1990, and certainly anyone who owns a house will have seen that in their rates bill that's come through over the last month or two. Substantial rises there. It wasn't unexpected, but still, adding some pressures through there as well. Insurance costs, they've been really, really strong over the last 12 to 18 months, and there are signs that for house insurance, contents insurance, and car insurance, that is all starting to ease back a bit. But the quarterly increases were still sitting up over 4% in general for those items. So still pretty beefy increases coming through. So households are not entirely over the hill on that side of things either. What interests me in terms of those numbers, I mean, you could look at all those sort of government influences and go, well, what's the underlying picture? The Reserve Bank can't really do anything about any of that stuff. But looking at the index, or the CPI index, excluding local and central government charges, that was down at 1.5%, so lower than headline inflation. So it suggests that the net effect of all those changes from the government, it sort of has added to inflation a bit, and the underlying sort of market pressures, when you look at the CPI now, suggest that because of the weak demand that we've seen, that price pressures demand pressures are pulling back, the price pressures are coming back as well. And perhaps if there was one number I could epitomise that with, it would be residential building costs, up in the last quarter by just 0.1%. That was the smallest quarterly increase in 13 years. And we've seen a massive drop-off in demand for residential construction and flowing through now into prices. Part of that is lower timber prices, but part of it is also just a suggestion that those cost pressures are coming back, and so firms are fighting for work more closely, sharpening their work more. They're putting their prices through more sharply, and therefore there is relief on the inflation side there.
Which is again encouraging news, right? When you look through all of those figures, and particularly like say the sort of residential construction piece, that was a key driver of inflation originally, and so that sort of coming back highlights not only how far we've come, but also that market pressures are evolving as you'd expect when inflation gets high. You raise interest rates in response, and funnily enough, they curtail activity to such a degree that you can't push on those price increases or price changes quite as much. So again, things are working, but of course that also leaves us now with an official cash rate that is still quite high relative to sort of what you might think neutral or normal might be at a time when inflation is basically back to where you wanted or pretty close to. And I think looking at the figures that came out on the inflation front, it does sort of highlight or confirm really everyone's expectations now that 50 basis points in November is sort of all but locked in. Yes, there's a bit of water to come under the bridge. There's, labour market data and what have you to come through. But realistically, that's a pretty good, strong starting number. Vindicates what the Reserve Bank did by accelerating their pace to go by 50. But also highlights that the reason they had to re-accelerate things is because they are probably still a little bit too slow moving. Does also, I guess, raise the spectre, right, of a 75 basis point cut when we come through to November. I mean, what will the Reserve Bank be sort of looking at, do you think, between now and then that could dissuade them from maybe going bigger, or anything that could convince them otherwise?
I think you'd have to see a really sort of some strong economic data coming through before then. And generally speaking, the indicators are on the softer side and still mostly softening. I find it hard to see anything that would dissuade the Reserve Bank from going with a relatively big cut this time around, particularly when you take it in the context of where interest rates sit relative to inflation. That real interest rate is actually quite significantly positive, which is a big contrast to where we were 3 years ago, where inflation was running rampant and interest rates were sort of slow to go up. And so, in fact, even at that point in time, interest rates are rising, but borrowing money seemed like a bit of a no-brainer because the prices were rising faster than your interest rate. So, you'd have to see an astoundingly strong labour market number. You'd have to see a completely out of trend lift in inflation expectations, which are already sitting back close to 2% anyway. I think for the Reserve Bank to be dissuaded from doing anything greater, particularly when you take into account the fact that they are going to be sitting on their hands for 3 months over summer and enjoying the Christmas turkey.
And especially when you look at the likes of inflation expectations, right, and they're going to be, being produced by forecasters who are looking at current inflation and probably going, we're actually in a much better spot. And on the labour market front, the fact that job ads are down at, more than the lowest in more than a decade, and the likes of filled job numbers, a little bit of a bounce in 1 month, but really not a lot to be talking about there. It just doesn't really give you much of a thought that those things will turn around all that quickly. Yes, there's a risk, and I think there's possibly a risk if you go sort of too many big cuts all of a sudden for the Reserve Bank, that maybe next year we start to rattle the cage a bit. But for now, totally agree. We'll assess how all of those various data points come in between now and the next review by the Reserve Bank, what further inflation data we get, and what it means for interest rates and the wider economy on one of our future editions of Econ Talks.